Good afternoon, everybody, and welcome to today's Professional Advisor Working Lunch, brought to you courtesy of our partners at Schroders. I'm Cherry Reynard, and I'll be your host for the next hour. Now, as you can see on the slide, before we get going, we have some housekeeping. So firstly, we'll hear from our guest speakers who'll leave time at the end for questions. I should inform you that today's session is being recorded, and we'll send you a link of that recording early next week. And please do feel free to share this with your colleagues. Then, as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with a link to the recording of the session. And that should arrive in your inboxes imminently. So on to slide 3. And today's speakers. So heading into 2026, the advisor landscape remains as complex as ever. So joining me to unpack it this afternoon and to share the results from the latest Schroders UK Financial Advisor Annual Survey is Stuart Podmore, Investment Propositions Director at Schroders. Schroders will be covering these results and to walk through the challenges facing financial advisors in 2025 and beyond. And then we'll be getting the advisor's point of view from Unique Financial Planning CEO Philip Martin. And together they will examine the survey results, focusing on the key opportunities and challenges that financial advisors need to navigate in the coming year. So do feel free to put any and all of your questions to our speakers using the chat function, which you'll find at the bottom of your screen. If you wish to remain anonymous, and simply select my name from the drop-down menu, and I'll take responsibility for it and put it in the chat box before you type your message. That way only I can see it. And now, just finally, before I hand over to our speakers, let me quickly run you through the learning objectives for today. So by the end of this session, delegates will be able to evaluate client sentiment regarding investments and articulate the potential impact on their portfolios, identify and analyze key challenges and opportunities relating to regulation, technology, and artificial intelligence, prioritize and summarize the essential focus areas for the upcoming year. So with all that CII and CPD covered, Stuart, over to you.
Thank you very much, Cherry, and hello, everybody. Thank you very much indeed for joining us. I should just say that Jamie Fowler, my colleague, is unable to join us today, given some commitments that have come up at very short notice. So you've just got me, I'm afraid, from Schroders, but I'm very much looking forward to discussing the advisor survey. What are advisors currently thinking? Just a bit of background, you know the history about the advisor survey. I'm very proud to announce that once again we've had a completion rate that sees above 220 responses from advisors. So we feel that is a robust sample group and in keeping with the trend over time. Also, I'd point out at this point that it was conducted online between the 21st of October and the 1st of November. So there is a reasonable amount of content in here that reflects upon some of the challenges that I think advisors and their clients are anticipating in the budget. So room for discussion there as well. We always start with market trends. I think back to our Global Investor Insight Survey, actually, in the middle of 2025. It reminds me of Harry Markowitz's on modern portfolio theory, would you believe it? Diversification is the only free lunch in investing. And I think that is very true of this first response. We always ask advisors up front, what do you think about the change in asset allocation over the last 12 months, and what are your expectations for the future? In the top 3, it's important to note that in the last 12 months, alternatives and emerging markets were there, and developed international equities, which would, of course, include US equity. I think advisors were absolutely on the money with that. I'll talk a little bit about the use of alternatives in portfolios, but those who have had exposure to alternatives, maybe in an investment solution of some description, will have undoubtedly enjoyed potentially, should I say, good returns if that had been managed well. And I think exposure to emerging markets cyclically and structurally was also a very sensible move from advisors, because emerging markets have been on the equity side as well as the debt side, the beneficiaries of a weakening dollar. When we look ahead to the next 12 months, emerging markets at the top of the tree, alternatives still there, and we would absolutely endorse that. In fact, I've delivered a web conference this morning on emerging market debt to our European clients, and I was really struck by some of the opportunities that exist in emerging market debt, and the fact that the technicals there have not yet seen the fund flow that you might get to see in the coming 12 months. What's noticeable here for the next 12 months, however, is that advisors don't see that significant exposure to developed international equities. I think that is a manifestation of people's belief that US equity and indeed other developed markets equities, including Europe and elsewhere, look pretty rich at the moment. They look overvalued. They're certainly at high valuations compared to or relative to their own histories. So it makes sense for me. The question on that developed international equity side, though, is, are there still opportunities for global equity and US equity in particular? And in our multi-asset portfolios at the moment, we're actually carrying an overweight to US equity as it stands. So there are some reasons behind that which we can explore. But I think advisors generally have been on the money there, and are quite correct. We ask everybody what their market expectations are over the next 5 years. I think higher expectations for equity relative to long-term averages has remained a little bit subdued compared to previous surveys. But yeah, that remains subdued. That sort of makes sense, I think, given the valuation story. And therefore, those thinking there will be lower equity market returns have increased. Higher bond market returns relative to long-term averages come down slightly. And again, lower bond returns relative to long-term averages, expectations have gone up. In a way, this is reminiscent of some of the things our Group Chief Investment Officer, Johanna Kirkland, has talked about. I think it is that if the bond market behaves, if bond yields behave into 2026, then that will be conducive to equity returns. Secondly, that we should remember that bonds are, at the moment, able to deliver income. That is one of the important aspects of bond investing. It's not just all about the correlation, and that we are potentially in a different environment from where we were post-global financial crisis and post-pandemic, for some where just simply those correlations were significant and it was pretty easy for multi-asset investors to load up on both asset classes. Now I think you've got to be a little bit more dynamic about this, especially if inflation makes its presence felt. So again, I think advisors on the money there. In terms of market expectations, this will come as no surprise. We always ask about volatility. Expectations are elevated still for market volatility. We would absolutely endorse that. A lot of people out there and market commentators talking about bubble trouble, AI, capital expenditure of the hyperscalers, valuations, like I said. The expectations have come down a little for lower market volatility. It seems like it's just par for the course here. There is a slightly more sanguine outlook from advisors on global growth. We would again endorse that. Our macroeconomic team here at Schroders has just recently revised its estimate for global growth up to 2.6%. So we would definitely concur with advisors there. Lower global growth on the right-hand side come down a little bit. So the question there is, how much of that growth will subsequently, and particularly in the US, lead to inflation? And how disciplined will the Federal Reserve be and the FOMC around the Fed funds rate into 2026? Will there be a degree of politicization there? And that could have a bearing on the direction of inflation expectations. We also ask, of course, about inflation over the next 5 years. And again, I think advisors are right here to anticipate that inflation might be a little stickier. Clearly, inflation is going to be challenging for bonds. So being active, being flexible here in the approach to bond exposure is important if this plays out. Expectations of lower inflation has come down. It could be that some of that higher inflation is driven by tariffs in the US, for example, but don't forget the one big beautiful bill is going to be a big fiscal boost. We just had only last night a cut of 25 basis points from the Federal Reserve. Some argue, like I say, that there could be greater political pressure on the Federal Reserve into 2026. So inflation might go up as advisors anticipate, and the corollary of that, of course, is that interest rates might well start to rise in 2026 as well. And advisors in this survey are thinking ahead and taking that view. So I think the perspective from the advisors in terms of what are advisors thinking right now, we would be very much in line with, and we think are potentially quite accurate as we look into the future. We always ask about other trends as well, the next 5 years, disruption, higher disruption. Yeah, well, the higher disruption answer has gone up. No surprise there. Lower disruption, of course, just bumbling along the bottom. And higher disruption is very much related to technological advances this year. And I think that's absolutely right. Lower disruption, I think, is a theme that advisors expect when it comes to environment and climate change. Certainly COP30, I think recently, with attendance in Brazil considered to be lower, and considering perhaps the political interpretation of some of the climate change approach, seems to have, I don't know whether peaked is the right word, but there has definitely been a change there. And so I think advisors are right here as well in terms of disruption. We are becoming more acclimatized, if you forgive the pun, to this direction of travel. Where it gets interesting is actually in the next chart when we ask about disruption. We've asked about geopolitical disruption again, an anticipation that this might come down next year. All I would say there is that a lot of it depends on those midterm elections in the US, perhaps, in terms of what Trump might or might not do. At the moment, commentators believe that the Democrats stand to gain seats in the House of Representatives. And if that is the case, then it could well become a debate about the cost of living in the US. And who knows, if tariffs are passing on price rises to the electorate, well, maybe Donald Trump will realize this and might well start to reduce some of the tariffs that we've had to grapple with in 2025. So it could be that geopolitical risk comes down a little bit into next year. We introduced a new question here, though, and you'll see that the standalone bar on this chart. There it is. Higher disruption due to fiscal debt sustainability. We believe at Schroders that 61% of respondents here are absolutely right. The stock of debt, in terms of debt to GDP ratios, has gone up significantly. But in terms of nominal GDP, that acts as a natural brake on returns in many respects. And the question here is how economies are fixed in terms of the debt servicing. And that is going to be increasingly important, we believe. And interestingly, as I referenced with emerging market debt just earlier in the discussion so far, that's a more of a developed market challenge right now. So I think that is a question that we will continue with the survey from here on in. So geopolitical risk, yes, but actually debt sustainability and fiscal discipline is going to become more and more important. Right, let's get into how advisors' clients feel about things. And this is very much, the next chart is very much a client sentiment question. It's always quite an interesting one, this, because we ask about those who are feeling bearish in the sort of royal blue colour, and we ask those who are feeling bullish, represented in the navy blue bars. And they look pretty equally spread at the moment. But that dotted line, middle, unshaded part of that bar chart, doesn't really change that dramatically over time. So I think sentiment it's pretty balanced according to the responses of our advisors when they think about their client sentiment. I think clearly there's lots of good reasons to be positive about next year. So the anticipation of productivity through AI, perhaps the earnings momentum we see in developed markets, particularly in US equity, looking positive actually in Europe as well. All reasons to be quite sanguine about the future. Similarly, though, with that fiscal support and potentially monetary support, that might be considered a positive as well. But at the same time, people are worried, like I say, about valuations. People are worried about debt sustainability and whether or not bond yields will behave. So I think that goes a long way to explaining why there's that chunk of people who are neither bearish nor bullish. And those that are bearish and bullish are pretty much equal to one another. It feels like it's a non-commitment from advisors' clients. And, well, to put it bluntly, I know how they feel. If we ask in a bit more detail about client concerns, we asked. We've changed the way we represent this data actually slightly. On the left-hand side, we talk here about the number one concern, and I think every year capital loss comes out tops. That's the number one concern yet again. Inflation, I think, in second place. Now, if you look on the right-hand side, the bar charts there are organised to show the frequency in the top three concerns, and capital loss is always in the top three. It appears more frequently and is very often in first place. But I do think it's quite interesting that inflation is up there, and that is quite revealing, I think. At this point, I just want to check in with you, Philip. When you think about your own client base and some of the things that you hear, does that description that I've offered in terms of client sentiment and in terms of the three factors that clients are most concerned about in the current environment, does that chime with your experience currently?
Somewhat, although I would perhaps say, Stuart, that they wouldn't be a uniform cohort. So this rather depends on where a client is in their investing journey. Obviously, the closer they get to retirement, or if they're already in drawdown, then how they would prioritise risks would be very, very different from if they were 30 years out, self-evidently. So part of that is driven by where they sit on that continuum. But in general, we spend a lot of time, I say this every time we face into this question, we spend a lot of time in our regular reviews and our positioning of initial advice that this is a long-term savings plan, that the asset base that they're going to go into is designed to achieve outcomes, real returns over the longer term. And that draws quite a lot of the sting out of the short-term noise that you get from market movements or other factors that are impacting on valuations from time to time.
Yes, absolutely. And I would add as well, to build on what Philip has said, we know that people are going to worry about capital loss, but we also recognise as investors in this environment that we can't just sit on our hands, and that there is a financial plan that sits behind, or should I say, that leads the investment contribution that we make, and there is a need for many clients out there to place that capital at risk under the right circumstances, according to the right objectives that clients might agree with Philip and businesses such as his. So I think that's an important part of what we're talking about here. And actually, I've noticed there's a question already about government policies. I might come back to this later in terms of the left of centre government that we have right now. But if you ask me where UK savers and investors might be in 5 years' time, in some respects, I'd encourage them to look through some of the political short-term impact of news flow and try to, as best they can, to think in that longer term. We ran some data recently at Schroders, and we looked at cash returns. We looked at returns on cash in cash ISAs, tracker ISAs, over a 10-year period from 2013 to April 2023. And we looked at this data as at April of 2025. And we realized that UK households collectively, by staying in those cash ISA products alone, had literally foregone something like £500 billion worth of returns compared to if they had invested in a global equity index. So that to us was really quite significant, and that's the thing I would be reminding clients about when it comes to concerns here. I mentioned earlier that there was we talked a little bit about those that are focused on sustainability. We're seeing an increase in, how do I put this, that actually less than a quarter it would suggest are explicitly specifying that their investments have got to reflect ESG factors. I talked about sustainability being considered to be less of a concern. That is definitely a trend that is reflected in advisors' clients' perspectives. And to put the point further, we've also asked about the trend that advisors observing clients seeking those solutions in recent months. And those that are seeing a large decrease and a small decrease actually have risen. So it would appear that this is definitely ebbing as a trend. I don't really want to make a prediction in the future, but I think fundamentally you could argue that we will have done a great job when it comes to sustainable investing in all forms of sustainable investing once it is fully integrated into investing. And maybe that's what's going on here. But that's a speculation, I think, on my part, if I'm honest with everybody. Okay, so let's go into financial planning. And here we've got some interesting stuff. Of course, like I said, we ran the survey before the budget on the 26th of November. So we were keen to find out from our survey, that's something we haven't spoken about before, had they carried out any specific financial planning in relation to any of the following. Tax-free cash from pensions, top of the pops there. Inheritance tax planning, of course. Additional pension contributions for higher rate taxpayers and wealth transfer. I know that various experts have talked about previous announcements when it comes to pensions being brought into inheritance tax calculations. It was very much from the point of view of the experts within our industry that they felt that when the government announced it, it wasn't just a question of if, it was definitely a question of how, and therefore when. I wondered here, Philip, if you had any observations that, it would appear that quite a few, over 35% or thereabouts, had taken those tax-free cash opportunities from pensions in advance of that, or at least had considered it. What's your response to that?
Crikey, well, if I had £10 for every time we've sold the potential for tax relief changes on pensions, and therefore the need to hurry and invest quickly, in my years in the industry, I'd be pretty rich by now. So, I mean, our view of this is we will not give advice on speculation of things that may or may not happen in a budget. So, we absolutely would not have been giving advice to people to take tax-free cash out of pension pots unless there was a specific requirement for them to do so at that time. That said, it was always pretty obvious, I think, in this budget that tax reliefs were not going up, that there was not going to be a more generous environment for savings after the budget than there was before, and of course so it proved. So there would have been a bit of activity around people accelerating plans to put money to VCT, EIS or other equivalent type vehicles ahead of the budget. So it was a bit of yes and a bit of no, really. It would be my reply to that.
Yes, but I think actually it's quite interesting to see that those levels, because it also reflects the idea that once that action had been taken, let's assume that those actions had been taken, about a third of clients in this survey, that it's very difficult to squeeze the toothpaste back into the tube, isn't it?
Well, it was the year before, if you recall, the people trying to return tax-free cash that they had taken inadvertently, that they didn't require. There were loads of providers that were being swamped by requests to take it back, which of course wasn't actually feasible in any case. I think it's maybe also worth bringing out the point you raised earlier on. I think the one change that we would be supportive of, probably everyone on the call actually, given our focus and understanding of the long-term benefits of an equity-related investment over a deposit, is that the reduction in the amount that can be held in an ISA on a deposit, I think, is a very sensible move. It's been dominated by deposit savings for far too long. There are obviously far more structural issues around how some of those institutions fund themselves if they don't have that deposit base, but that's a separate issue, obviously.
Yes, yeah, no, I would agree with that. I actually think this slide, in many respects, is an endorsement of financial advice. And this to me says that actually, thank goodness for advice, and thank goodness for financial planning in advance of budgets, because it is possible, as we saw with all the kite flying prior to the announcement of the budget, the media coverage, it is possible to be panicked into sudden and irreversible decisions, and I think that's always a symptom of perhaps an undesirable situation. And I like to think that many advisors out there were able to stop clients from taking knee-jerk action such as that. I think in the next slide we get a bit more detail here. So we asked a further question about the following strategies, and this is slightly different here, actually, Philip. This is a discussion about strategies in response to the proposals, for those unused pensions to be brought within the inheritance tax calculations. And this again is if nothing else, I guess, Philip, it's an illustration of financial planning at work. So working out how to manage that and enhancing a financial plan with a client to, for example, take advantage of regular gifting, to think about withdrawals out of normal expenditure. This all to me makes absolute sense. Would you agree with that?
Totally agree. In the end, it just adds an extra layer of complexity to the work that's already done around tax wrapper optimization, sequencing, and how best to develop a plan for income and retirement across a number of different potential routes.
On a similar theme, to move to the next slide, we also asked advisors if they've made any changes, or should I say the changes from the macroeconomic and market environment in the first year of Trump's second presidency. Had that caused any clients to adjust their financial plans? Now, when we ran the Pulse survey earlier in May this year, obviously Liberation Day was fresh in everybody's minds, 39%, but that actually ticked up a little bit to 44%. I was a little bit surprised by that. And it's a way of answering the impact of geopolitical risk on financial planning. In order to investigate this further, I was left thinking about the fact that when we look at history in terms of US equity returns, whether there is a Democrat or a Republican president in the White House, the returns of the S&P 500 actually under either of those presidents is pretty much neck and neck. In fact, I think the Democrat presidents are a little bit more conducive to S&P 500 returns, but it's marginal. And I think it's worth reminding clients that whilst we are seeing some volatility at the moment, it is very difficult to invest through the impact of geopolitics. And maybe I'm misinterpreting this here, that those who said yes to the tune of 44% are actually placing more capital at risk for their clients' portfolios, maybe extending exposure into US equity. So maybe they thought that was the right thing to do. And I think it's just worth reminding that in behavioral studies previously that have looked very closely at this, very often if people don't like the incumbent of the White House, they will tend to de-risk and go to cash. And they will miss out on the returns that I described earlier, which, remember, are marginal between both parties in the US. I think that's a reminder that your investments don't really care about politics. And this is back to the fundamentals of financial planning.
I guess the counterpoint to that, though, Stuart, of course, is that President Trump is no normal Republican, is he? And the strategies that he's adopting wouldn't be comparable to those of his party's previous incumbents. So there is perhaps a greater degree of uncertainty, frankly, from day to day, not just from the implementation of a policy, but just day to day about where it's all going.
Yes, I sympathise with that perspective, Philip. I think you're right, but I think in terms of anecdotally, if it's true, as some commentators have suggested, that Donald Trump is very often influenced by the last person he seems to have had a meeting with, then that is a very difficult environment in which to invest, or indeed to make significant decisions on financial plans. We asked, to go back to the macroeconomic part of it on the next slide, we asked about interest rates perhaps not going down as quickly as was anticipated. And I think we were right here. Certainly our interest rate expectations have typically been a little elevated versus market consensus, according to the futures market. So in terms of interest rate futures, so here at Schroders, our macroeconomic team has had us a little higher than the consensus in the US, a little higher, or more or less converged in Europe. And certainly we've been anticipating higher base rates here in the UK than the market consensus. But we thought that actually if rates were not coming down as quickly as people had wanted rates to come down, we thought it was worth asking the question, are you having conversations with clients about long-term investing versus cash deposits? And clearly we go back to that £500 billion risk for UK households that we mentioned earlier. The answer here is overridingly yes, once again. It's dropped a little bit, but it's still quite significant. I think that's ultimately a good thing. I would like to see financial planners still engaging in that conversation, because the risk is that even clients of financial planners go off and do that without almost letting them know. I know there are examples of that sometimes. I feel it's better to have the conversation than not. What's your thought on that?
Totally agree. It's the cornerstone of any conversation that we'd be having with clients. I mean, I think it's far less now a conversation of should you be wholly in deposit based or cash related savings, or should you be investing in markets for the long term. The conversations now tend to be a bit more: am I holding enough in cash? Do I have an adequate amount for liquidity? And a lot of that, of course, is linked to capacity for loss and assessing capacity for loss as part of giving advice, which is obviously an integral part of the FCA focus.
And then finally in this section, we asked also about retirement conversations. It's obvious why we've raised this question, but over the past year we said, have you had that conversation about the suitability of annuities versus drawdown? And it would appear that has been high and remains consistently so. I think it's fair to say that conversation might well remain. Okay, now let's move on, because I'm just conscious of time, and I think we've got quite a bit to get through. We talked product and proposition evolution with clients as well. We asked about the number one concern here, and regulation always scores number one. Again, we've just reorganized this chart similarly, in a way similar to the previous chart. So we've asked about the number one concern, and that is definitely regulation. And on the right-hand side, we've put a bar chart there to reflect the frequency in the top three, and regulation comes up trumps at the top in a very similar way to capital loss in the previous slide. What I find interesting here is the number one concern that stands out here is finding new clients. And as we'll see, I wonder if that comes or is related to the demographics of the client base. So we've got a couple of things there that seem to have jumped in significance. Firstly, I think it's servicing clients, and secondly, it's finding new clients. And we might explore that in the next few charts in a bit more detail. We also asked clients about how would you describe the impact of targeted support on the advice model and the proposition. There was clearly a link here to Consumer Duty. The most significant response here is in the neutral category, right in the middle of that chart, actually. So the response here, in the majority of cases, is limited impact. We don't think it's going to affect our current advice model significantly. Any views on that, Philip?
I'd agree with that. I mean, I think it depends whether you're taking a 20-year horizon in forming your view here, or whether it's below that. But I think, in our experience, the dominant, overwhelming majority of clients that we engage with are here because they want to take advice. They want to have a plan put in place. They want to be reviewing on a regular basis. They want somebody else to take the strain, and they want the reassurance of knowing that they're doing the right thing. That is not going to go away with alternative models. I think the alternative models will definitely start to penetrate into other parts of the market that are perhaps uneconomic for us to serve at the moment. And that is a good thing, obviously. But in terms of our existing base, we don't feel enormously threatened about it in the short term. Okay, and to build upon that, I mentioned the demographics just before Philip answered that question. We asked about the average age of the client base, and the average age of the client base, I actually would draw your attention to the top layer there. The average client age has jumped significantly. So from 25% to 38% of the client base is now over 65. I wonder if that has a bearing on the data that we saw a couple of slides ago, actually, where we saw concerns growing about finding new clients. Maybe this is a recognition from advisory businesses that actually the demographics might not be in their favor here. And that client age profile and its changes over the last 5 years, it's in combination actually with the data on the next chart, which is the minimum asset size for new clients. So that at the same time is falling and has fallen. Again, it's quite significant. There's been a clear upward shift in the minimum asset thresholds.
Look at that on the far right-hand side of this chart, where 200,000 plus is now the case for almost a third of the minimum asset sizes for businesses. Is that a trend you recognise, Philip?
Possibly at the margins, but these wouldn't be hard numbers that we would apply in our business anyway. I mean, there are lots of reasons why you might be engaging with somebody that has considerably smaller amount of money than that. They could be a relative of a client of long standing that has assets, or a friend of that family, or whatever it happens to be. I mean, I think the interesting thing out of all of these things that we've talked about so far is the opportunity now to properly start engaging with the wider family and potential inheritors of existing client assets. And obviously gifting is coming back to the fore, given some of the budget changes and its impact on pensions. So you will always have clients who are resistant to that because they want to segregate their own finances away and don't necessarily want the children to know. But as these other things start to impact on a plan that starts to move assets between generations ahead of death, it starts to naturally draw the family and therefore a future client base back into a conversation. So while on the face of it, a lot of this stuff can look very depressing overall for advice businesses, there are a number of factors that actually could be very, very positive for them.
Yes, it's an interesting one, isn't it? I wonder whether government regulation and government policy might be the catalyst that forces advisory businesses to think more constructively and more methodically about intergenerational wealth transfer. I know through this particular survey, we've been talking about it for some time, and it is important. You know, we ask here about, are you concerned that your business could lose assets? And there's been a slight uptick there to 66%. I think that is quite right, that actually there is some business at risk here.
The one thing you can say with absolute certainty, Stuart, is that if you have no relationship with the person that inherits the assets, you will lose those assets. You know, you can say that with absolute certainty. Yeah.
Yes, and there are plenty of online platforms and applications that make their way to mobile phones, which will be far more conducive to conversations with younger people at the same time. So yeah, I think that remains very much perhaps a threat to advisory business in the future. Maybe that's why the response earlier about greater concerns was related to finding new clients and also servicing those clients. Who knows? I think the client acquisition strategy for younger investors, though, hasn't really changed a great deal. In fact, if anything, a separate, differentiated approach to that segment of younger investors has actually decreased. The answer to that question negatively has gone up to 85%. And then, of course, retaining, attracting, and advising women, female clients who very often are the acquirers of or outlasting spouses, partners. There's no differentiated approach here, which is somewhat worrying if those businesses are to retain those assets into the future. So that doesn't seem to be recognised in the answer to this question yet. And I think with the thresholds that we discussed just now, and the fact that I was pointing out minimum thresholds at 200,000 for clients across the survey, recognising that's not necessarily something that's important in the case of your business, Philip, we wanted to ask about the opportunity of some clients investing into a long-term asset fund. Now starting to appear on platforms and become more accessible for advised and UK wealth clients. It's spreading, and I thought that was really quite interesting. In terms of the year-on-year question that we asked here, there's been a slight increase. I don't really want to predict how this is going to move or how quickly this is going to move, but I suspect that we are at the start of perhaps a longer-term trend here. And I don't think it's going to move rapidly, but I do think that this question is an important one to retain in the survey for years to come, because I would imagine that in the quest for diversification and the opportunities for exposure to private assets in an evergreen fashion and a way that protects retail advised clients and gives a degree of comfort about that liquidity, semi-liquid approach as it's known, then I think that is a trend that is likely to continue. And then the final part related to demographics, I think, is just to reflect on vulnerable clients. We asked this question in terms of the percentages. Those have increased a little in November 2025. The percentage of the client base that you would categorize as vulnerable has increased up to a quarter of that client base, as you can see in the third set of bar charts from the left. Maybe that just correlates very closely with the changes I identified earlier in the demographics. In other words, there's a clearer correlation perhaps between vulnerability and age. And that's how I would explain the response to that question. We asked a little bit about lower value clients as well. And we asked about the strategy for managing any clients that are no longer economic. And developing a lower cost, lighter touch proposition so that you can retain them is really important in November of this year with this survey, just as it was in the Pulse survey back in May. So I think a lot of advisors are still continuing to prioritize client retention through that the development of a lower cost, lighter touch proposition. And there, I think, is the opportunity for outsourcing. We asked about fees, and I'll be interested here, Philip, if you have an observation, but we asked the question, is there downward pressure on the advice charge? And those that have said no has increased into November of this year. Any perspective there, Philip, that you would share?
Well, I wouldn't be saying it's no. I would say it's still a very, very live issue, and I think that the general move is definitely downwards and continues to be so. I was reading a report last week that suggests it's drifted down a median number from 95 basis points ongoing to closer to 85. So it's in the last 18 months, I think. So we definitely see that drift down, and I think it will continue. I think all of this ultimately comes back to, in a low inflation environment, how do you generate enough returns such that the cost of the asset plus the cost of the advice plus the cost of the platform plus inflation is still a positive number, and that becomes quite hard to do.
Yes, and I think that's corroborated by the findings in this chart, because we've seen an increase in the number of, or the percentages of businesses that are charging between 50 and 75 basis points.
Yeah, it'll be rising.
We would agree with that. I'm just thinking about time at the moment. I mentioned earlier in terms of outsourcing that the percentage of clients that are managed externally is pretty similar. Those at 51%, so advisors with 51 to 100% of assets outsourced has risen from 27% back in 2020 to 35% in this most recent survey. So clearly a direction of travel there, and that might well be part of the servicing of maybe lower value clients. I think that's quite interesting. And actually that multi-asset opportunity for perhaps the majority or the larger segments there that might not have quite the assets of some of the more significant clients, it suggests on the right-hand side of this chart that multi-assets are going to have a big part to play in that. Discretionary fund management in the middle of that chart has ticked up slightly. Multi-manager providers have ticked up. Multi-asset come down slightly, but still, very significant as well. We think those trends run alongside one another. They're complementary. And then the final question in this section, before we go to the last part and we invite some more questions from the audience, the final part in this section was the question about, for those clients invested in multi-asset portfolio service portfolios, do you have access to liquid alternatives and gold in asset allocation? The last time I looked this morning, or was it yesterday, I think gold was at $4,230 a troy ounce. That was a couple of years ago when I interviewed James Luke, who manages our gold strategies here, and I think gold was at about 2,700, and he very clearly said that it had the potential to go above 4,000. In fact, he talked about $5,000. And I think that discussion from our multi-asset managers in front of many clients here in the UK that are advised, we talked about making sure that clients had access to alternatives, but that they understood where the exposure lay, how that was managed within a multi-asset environment, and the importance of gold, for example, in being a geopolitical hedge, a diversifier, and the importance of liquid alternatives, and particularly liquid alternative hedge fund strategies that are made available to retail clients and that can really make a big difference to portfolios. The answer to that in this survey is yes, 60%. So the majority of advisors are saying yes, their clients that are invested in multi-asset do have exposure to that. I just think that's worth checking for advisors, and just to understand a little bit about how that is managed in a bit more detail. But I think that into the future, when we think about portfolio resilience being a big priority, 55% of our global investor insight survey clients around the world put that as top of the tree for their priorities. That resilience, like I said before, is very much delivered through sensible diversification. And I believe that has to involve a degree of protection and uncorrelation via liquid alternatives and potentially the hedge against geopolitical risk through gold. But there are other structural drivers into that gold play as well. So that was an interesting question to ask at the end there. And then finally, I don't think any presentation in 2025 has been delivered by any investment house or indeed anybody within our industry without mentioning AI. I mean, my first question to the audience on AI is, who is bored of hearing about AI? Well, maybe you are, maybe not. We asked a couple of AI questions, and this, I think, also relates to some of the concerns that I talked about earlier for financial businesses, financial planning businesses, because they talked about servicing clients and finding new clients. You know, can AI bring improvements to productivity? Can technology take some of the weight off the shoulders of paraplanners, for example? So we asked, you know, does the development of AI technologies such as ChatGPT, does that represent an opportunity or a threat? And some think that there is a degree of threat still, 1 in 4 it would appear, but I think that is reasonably sanguine on the outlook. Maybe people's response here was influenced by the market perspective on AI and a lot of the commentary there that suggests that we all need to be very worried. It's very easy to get caught up in that discussion. But yeah, confidence in AI's potential has grown over time, and it's just tailed off a little this year. Do you have any observations here, Philip?
Well, it's a very broad question whether it's a threat or not. I mean, I think to whom would be my first response to that. So I think it will become an integral part of running an advice business. It doesn't hold any fears for me that it will replace a skilled advisor managing a client relationship. That person-to-person engagement will always be needed. I think it has enormous ramifications for how we deliver the paperwork and the reporting that is required to underpin the advice. And as somebody that owns a business, that means I should, in principle, in time, be able to run that business far more effectively. So it could have a threat to some of the mid-skilled people in the back office whose roles could begin to be done in a more efficient way. So there are threats, but there are opportunities depending on your perspective and where you sit in the business.
Thank you, Philip. I think your microphone, I do apologise to the audience, there is quite a bit of feedback there. So if you didn't hear everything that Philip said, I think there is a recognition from his perspective that there are going to be opportunities as well as threats, and that actually to a certain degree, there might well be an opportunity for businesses to become a little more efficient in their approach. We also asked, when it came to AI, about how soon businesses might anticipate incorporating AI-based technology applications into the advice process in some way. I just draw your attention to the left-hand side of this chart first. Look at that. I've already implemented some form of AI technology, has jumped up to almost half of respondents. When we first asked this question back in May 2023, on the right-hand side of the chart, 27%, so almost a third, said never. We are never going to do it. It's quite an extreme statement to make. The nevers have dropped significantly from 27% down to 8%. So there, to me, is a recognition that this is something that advisory businesses will have to entertain, and who knows, that if they need that efficiency, if they need to protect their margins, then maybe this becomes something of necessity. But I thought it was really interesting to see that some have implemented this already. And it'll be really interesting to see how that trend continues. And then finally, and this relates to some of the other things that we've been discussing today, the question, where do you think AI has the potential to help your business the most in terms of being most helpful. The obvious one, of course, is efficiency and automation. I think here, one would expect that, as Philip just rightly described, the administration of the business, any back office opportunities or back office operations, well, then there's a degree of what we might describe as operational alpha on offer here. But I also think it's important that as this develops and evolves in future years, I wonder whether AI will have more of a role to play in client engagement and personalization. Now, however you might choose to define that, might well change or vary between us if we had a debate about it right now. But that client engagement and personalization and what AI might be able to do in that stage of prospective client communications, existing client communications, to a younger client base, or at least a younger through intergenerational transfer, well, then that is definitely a point of interest in the future. Maybe, Philip, if you've got anything to add on that, you have an opportunity to do.
Yeah, well, apologies for my microphone if it goes again, but well, I agree with that. I mean, I think a lot of that to me will end up, I think, being linked to wider use of AI in the outside world. While I think at the moment people seeking advice absolutely value a human-to-human interaction, I can see a world in 10 or 15 years where I'm watching a film that doesn't have any human actors in it, where I'm conveyed from A to B in a car that doesn't have a driver in it, where I'm taken on a train that doesn't, heaven forfend, a train that doesn't have a guard on it or a driver on it either. And in that environment, I can see people's resistance to dealing with financial affairs in a non-human to human way breaking down as the rest of society changes in a similar way. But as we sit here today, I think the primacy of a human talking to a human is still a vital part of the USP of the advice business, and I don't see that diminishing in the very short term.
Yes, and I would agree with that. I would just say from an investment perspective as well, when it comes to AI, it clearly a lot of people are picking up on the bubble trouble and the nervousness that commentators are expressing. I would just say that the investment opportunity into artificial intelligence and all aspects of it relies very much on what we describe as the tech stack. And the opportunities vary depending on which level you're dealing with there, whether it's the application level or the compute level, or indeed the large language models that are being developed at the moment. And the impact that AI has on different sectors, different businesses, it all suggests to us that being active and fundamental in the investment approach when it comes to AI and technology in the coming months and years will be critically important. And the idea of simply gaining passive exposure to this area is dangerous, because we are at a time when you really do need to understand the dynamics of capital expenditure and future revenue streams, and where that benefit in terms of AI is going to be monetized. I think actually that takes us to the end of the presentation, Cherry. I've tried to answer some of the questions along the way, and bring in Philip for comment as appropriate. I just wondered if there are any further questions to ask as we close in on the hour.
Well, thank you, Stuart. I think you've done a great job of answering questions as you go along. One thing I was interested in was that idea of new clients, and that advisors are worried about getting new clients and yet don't seem to be tapping into this sort of rich opportunity of the next generation, which seems like, I mean, I hate to describe them as a sitting target, but like quite an easy win. Do you have any sense, I mean, Philip or you, Stuart, why that isn't happening? Is there some kind of, are there not the natural structures in place to deal with those lower wealth clients, or what's the problem?
Yeah, I agree with you, Cherry. I mean, if I offer my view before Philip, I suspect that Philip is the key person to answer this question. But I am struck by that too. why, if you recognize the business necessity of finding new clients, would you not be developing your segmentation process to try and acquire those clients? And therefore, why would you then not be amending how you put your proposition together to maximize the benefits of technology to suit that younger client base, or to suit the increasing wealth that you will see residing with female clients in the future? I don't quite get that. I'm not quite sure how that adds up. I don't know whether it's, I don't know how to describe it, whether it's evidence of businesses just not recognizing a problem just yet, or whether it's that businesses are starting to recognize the problem, but they haven't yet started to take definitive action to address it. If it's the latter, I would say to those businesses, well, sooner rather than later. I don't know whether you had anything there.
Well, only to say, I think, one of your stats earlier on, Stuart, was the average age of a client. I think you said was now the majority were naming 67. So this entire new and inverted comma client question is either about aggressive expansion because you're trying to grow, or it's a defensive measure because you're trying to protect the assets you've got. And it's not quite as easy as just there's a sitting duck. Why are they not just clients? Because there are lots of reasons why. Sometimes the existing client doesn't want their kids involved in their financial affairs. So no matter how you might try and draw them into the planning as a family, they don't want to do that. So for us, we've taken a far more softly approach to try and just start to just gently develop relationships with that next cohort of inheriting people. The occasional event, invite them along, send them material that we would be sending to clients to say, we're here, we look after somebody else in your family's financial affairs, perhaps we could help you too. So it's just it's almost like we used to call it 20 years ago with permission marketing, where you're just starting to gain a relationship in a very soft way to move it from very cold up the heat spectrum to warm, and then hopefully it gets to a hot relationship that becomes an inheriting. And to us, that feels like a more natural, organic way of developing it.
Yeah, absolutely. Now, apologies, we probably only got time for one more, but obviously if anyone does have any extra questions, please do direct them to Schroders at the end of this. The next question was about the left-leaning budget, and what, and we're assuming this government survives. This could be going on for another sort of 4 years or so, and they're asking what the implications of that might be for savers.
Well, I think I referenced this briefly earlier about government policies with a left of centre government, and what some commentators are describing as the tax and spend approach, the welfare bill rising. Yes, I would say that this fits with one of the challenges that other liberal democracies certainly face. The US to a lesser extent, but certainly other democracies, economies around Europe. It's very clear that states are stretched. There is a fiscal stretch going on here, and an attempt to try and balance the books, whilst recognizing at the moment that there also needs to be a degree of investing in infrastructure that is looking a little tired. And there are lots of demands on that public purse, and a big part of that, by the way, is the aging population, the aging demographic, and we've talked about this before in the 3D reset, as we called it. That's going to cost governments more, and potentially is going to challenge on growth as well. So to a degree, I seek to take the politics out of it, because of course we aim to be apolitical in our approach here. But the second part of the question, well, where does that leave UK savers? Where will they be after 5 years? I take you back to the diversification opportunities. I take you back to the fact that emerging markets is an allocation that advisors in our survey believe will increase in the coming 12 months. Emerging market equity as well as emerging market debt, I would argue. Similarly, that the use of alternatives can be beneficial here on a global basis that brings your net exposure to markets down. The opportunity to benefit from exposure to private assets in long-term asset funds, the opportunity even in multi-asset portfolios, which are highly efficient and relatively cheap and easy to access, and yet still give you liquid alternatives, gold exposure. These are the ways of coping with that. These are the ways of providing UK clients with the returns that they need in spite of some of those challenging government policies, if you believe those policies to be incorrect or indeed too extreme. So my optimistic perspective on this is there is always a way to find a route to the investment that you seek to deliver according to your objectives, and that will continue.
Okay, great. Thank you, Stuart, and thank you, Philip, as well. There was so much food for thought in there. Thank you to the audience for your questions. And just to repeat, if you do have any more, please do reach out to the speakers and we will endeavour to answer them. Just before we wrap up, let's take a quick look at those learning objectives again. So by the end of this session, delegates will be able to evaluate client sentiment regarding investments and articulate the potential impacts on their portfolio, identify and analyse key challenges and opportunities related to regulation, technology and artificial intelligence, prioritise and summarise the essential focus areas for the upcoming year. So that is all we have time for today. Thank you again for your questions. Thank you to Stuart and Philip for joining me. Now, just before we do close, I'm going to leave you with a little teaser. Hopefully this is coming up now, of what's to come from PA events as we move towards the new year. So this is our final event before the Christmas break, but we'll be back on the 15th of January with our Scotland Investment Masterclass, which is an online event featuring presentations from Copier Capital, Downing, L&G, Orbis, Schroders and Tatton. If you're listening to this event in Scotland, please do look out for the invitation in your inbox. We'll be back on the road again in the final week of January with our annual Q1 Multi-Asset MPS Roadshow. On the 27th, we'll be in Running Park in Harrogate, 28th in Warrington, and on the 29th, we'll be returning to the National Conference Centre in Birmingham. Then it's Lee Court in Bristol on the 4th of February and finishing as ever at 1 Whitehall Place in London on the 5th. And that roadshow includes Aberdeen Adviser, BlackRock, HSBC Asset Management, Morningstar Wealth, Orbis and Quilter. So that's a total of 9 hours CPD over the next couple of months. As ever, if you wish to find information or to sign up to any of our events, you can do so by visiting professionaladvisor.com/events. So that's it for today's session. As ever, our greatest thanks go to you, our readers, for your company this lunchtime. I hope you found the session helpful and worthwhile. And if you did, perhaps we'll see you again in the new year. Goodbye to both our speakers. Thank you very much for joining us today. And then until we meet in the new year, let me wish you all a very happy Christmas from all the staff at Professional Advisor. So goodbye.